Welcome back to our Beginner's Options Trading class. This is part 2 of our series where we continue our journey into the exciting world of options trading. As your guide on this expedition, I'm here to make sure that we navigate safely and effectively through the often complex terrain of options strategies. This part of our journey will be filled with new concepts, strategies, and ways to approach the market. So, buckle up, and let's dive right in. Before we get into strategies, let's do a quick recap of what we covered in part 1. Options are contracts that give you the right to buy or sell an asset at a predetermined price, known as the strike price, by a certain expiration date. You pay a premium for this right. There are 2 types of options, calls and puts. Calls give you the right to buy, while puts give you the right to sell. Make sure you're comfortable with these concepts before we proceed. Now, let's talk about 2 basic option strategies: buying calls and buying puts. When you buy a call option, you're essentially taking a bullish stance. You believe the price of the underlying asset will rise before the option's expiration date. If that happens, you have the right, but not the obligation, to buy the asset at the agreed-upon strike price, potentially selling it later for a profit. On the other hand, buying a put option is a bearish move. You anticipate the price of the asset will fall. In this scenario, you have the right to sell the asset at the strike price, even if the market price has dropped significantly below it. This could lead to profits if your prediction pans out. Both these strategies offer the potential for significant earnings, but they also come with risks. Remember, if the price movement doesn't go your way, you could lose the entire premium you paid for the option. These are straightforward strategies that you can use to speculate on the price movement of an underlying asset. A popular strategy for generating income is the covered call. This strategy is used when you already own the underlying asset and are okay with selling it if the price rises above your set strike price. Let's break it down. When you sell a call option on an asset you own, you're granting someone the right to buy that asset from you at a set price within a given time frame. In exchange, you receive a premium. If the asset's price doesn't rise above the strike price by the option's expiration date, you get to keep the premium. This strategy is a fantastic way to generate extra income from assets you already own, especially if you believe their price will remain relatively stable. However, there's a risk. If the asset's price skyrockets, you'll have to sell it at the strike price, potentially missing out on significant gains. It's a bit more advanced but can be quite rewarding. On the flip side, there's the protective put strategy. This is an interesting strategy that revolves around the idea of safeguarding your investments. It's like buying an insurance policy for your stocks or assets. So how does this work? Let's break it down. When you own a stock or other asset, there's always a risk of the price falling, right? Now imagine you could put a safety net under that asset, a net that catches your investment if the price starts to plummet. That's essentially what a protective put does. When you buy a put option as a protective put, you're securing the right to sell your asset at a specific price, the strike price, within a certain period. If the asset's price drops below the strike price, the put option gains value. This increase in value can help offset the losses from your asset's price drop. So in essence, this strategy is all about hedging your investments. Options spreads involve using multiple options to create a more complex strategy. One of the most common types of spreads is the credit spread. This might sound a bit complicated at first, but stay with me as we break it down. Imagine you're at a marketplace. You're selling apples at a higher price and buying oranges at a lower price. That's pretty much how a credit spread works in the world of options trading. You're selling an option, usually one that's at or near the money, and buying another option. The option you're buying is further out of the money and has a lower premium. This difference in premium is where the credit in credit spread comes from. You receive this credit when you open the position. If the price of the underlying asset stays within a certain range, you get to keep this credit, which is your maximum potential profit. Remember, the key to credit spreads is balancing reward and risk. It's a way to generate income while managing risk. The iron condor is another spread strategy that involves both calls and puts. It's a strategy that's a bit more complex but can be quite lucrative for traders who have a good understanding of options. The iron condor strategy is designed for scenarios where you expect the price of an asset to remain within a certain range over a specified period. So, how does it work? Well, in an iron condor strategy, you're selling an out-of-the-money call and an out-of-the-money put, while simultaneously purchasing a further out-of-the-money call and a further out-of-the-money put. This creates a range or wingspan for the asset price, hence the name Iron Condor. The beauty of this strategy is that it allows you to profit from the lack of movement in the asset price. Essentially, you're betting that the asset price will remain stable and within your established range. The goal is to profit from low market volatility. Let's dive into real-life examples to better understand these strategies. Picture this. You're a trader who has just bought 100 shares of a booming tech company. To generate some extra income, you decide to sell call options against your shares. This is a covered call strategy in action. Now let's say you're an investor who has a substantial holding in an automobile company. The industry is facing uncertainty, and you're worried about a potential price drop. To protect your investment, you buy a put option. This is a protective put strategy at play. Imagine another scenario where you're a seasoned trader looking for a strategy to profit from a stable market. You decide to sell an out-of-the-money call and put, while simultaneously buying a further out-of-the-money call and put. This is an Iron Condor strategy being employed. We'll walk through scenarios that demonstrate how each strategy can be applied. That's a wrap for part 2 of our beginner's options trading class. We've navigated through the basics of buying options, covered calls, protective puts, spreads, and iron condors. We've also seen them play out in real-world scenarios. But remember, this is only the tip of the iceberg. The world of options trading is vast and holds more strategies to discover. So stay tuned for part 3, where we'll delve deeper into advanced strategies and risk management. Until then, happy learning and happy trading.